Welcome back to the Deep Dive. Today we're tracking a really complex pivot in global shipping. A structural rebalancing so significant, it's basically shifting the industry's entire center of gravity.
It really is.
For decades, I mean, the whole dry bulk world has revolved around Beijing now. All the data seems to be pointing south and east, firmly toward Bangalore.
It's a huge story.
We've gathered a ton of sources, everything from market intelligence reports to raw freight forwarder data, and they all prove this isn't some abstract forecast.
No, this is happening right now.
It's a tangible shift, and it's reshaping, cargo flow, tonnage demand, and freight behavior. So our mission today is to distill what this all means for the three major vessel classes: your Capesize, your Panamax, and your Supramax ships.
And this is really essential stuff for anyone in the global trade space. The dry bulk trade, you have to remember, is the physical movement of the global economy: iron ore, coal, grains. And what we're seeing is this profound split. It's driven by two completely different economic cycles. China, which is in a kind of slowing maturity phase, versus India's really rapid industrial acceleration.
And understanding that split is the key.
It's the only way to strategically position yourself for what's coming.
Okay, let's unpack that, starting with the first part of the equation. China. We've all come to rely on this insatiable Chinese steel machine, but our research suggests that engine is clearly easing off.
It is, yeah.
What's the fundamental cause there? And how quickly does that translate into them buying less raw material?
Well, the cause is structural, which is the important part. It's not temporary. China has, for the most part, completed its massive urbanization and property build-out.
The ghost cities we used to hear about.
Exactly. The sources point directly to a sustained weakness in the residential property sector, which, used to consume staggering amounts of steel, sometimes 60 or 70% of all their domestic demand.
Wow.
So when that slows down, the entire commodity chain just fuels the shockwaves.
So if the construction developers aren't buying the steel anymore, what do the Chinese mills do? What's their immediate reaction?
Well, they can't just shut down. The fixed costs are enormous. So the only real consequence is that they're driven to export and to do it aggressively. We're seeing steel export volumes hitting multi-year highs.
So they're just pushing it out.
They're pushing it out. The data shows specific movements from ports like Tianjin and Rizhao heading to Southeast Asia and the Middle East are up like 30 to 40% year on year.
Yeah.
They're essentially dumping excess capacity onto the global market.
That's fascinating.
Yeah.
Because they still need the raw materials to make that steel, right? They still need the iron ore and coking coal.
They do, but the way they buy it has changed.
How so?
That raw material intake has become hypersensitive. It's almost reactive to sentiment. In the boom years, demand was predictable. It was massive. Now, if they feel even a slight domestic wobble, the mills pull back on imports immediately.
Tighter inventory management?
Much tighter. And this is crucial for the biggest ships, the Capesize vessels. They're the ones carrying iron ore on those long-haul trips from Brazil and Australia. The whole Capesize story now just swings wildly based on China's mood month to month. It creates this massive, fast volatility.
Okay, so that's China. Volatile, slowing down. But at the same time, as you said, there's this new engine accelerating.
A completely different story.
Let's focus on India. They seem to be picking up the slack, but it looks like they have a totally different commercial profile.
Absolutely. India is expanding its crude steel production at a really remarkable rate. Our analysis shows their annual production has already climbed past 140 million tons. And importantly, capital is still pouring in to fund more capacity.
And what's fueling that? Is it just general optimism, or are there specific projects driving this need for steel?
Oh, it's very specific. It's all driven by these multi-year infrastructure commitments. We're talking large-scale highway and rail networks, massive port expansions, and government-backed manufacturing programs. This creates a really deep, consistent domestic demand.
And this is the key question for shipping, right? How does what India needs to import differ from what China needed at its peak?
It's totally different. And this is the core of the shipping story. China's needs were just all-encompassing. Huge volumes of lower-grade iron ore for basic construction steel.
Right.
India's growth is different. It requires steady, high-quality coking coal, which they often import from Australia or South Africa because they're focused on higher-grade manufacturing and industrial steel.
So less iron ore, more high-grade coal.
a bit more nuanced than that. They still import some ore, but their big focus is on coking coal, and interestingly, on creating this intense web of coastal and regional movements for the finished steel itself.
Ah, so moving the final product around.
Exactly. That finished steel has to get from the big plants on the coast to all the distribution hubs in the interior or get exported to nearby countries. It completely changes the logistics. It's less about massive ocean voyages and more about high-frequency regional logistics.
That distinction from a single long-haul raw material anchor to a complex regional logistics hub, that feels like the core insight here. It tells us we need to look at how the actual trade routes are being rewired.
We're moving from what was, a single anchor demand engine where China basically set global freight rates to a multi-hub system. China's still the biggest player, but its influence is being diluted. India, Southeast Asia, think Vietnam, Indonesia, and the Middle East are all now absorbing critical volumes of both raw materials, and that finished steel China is exporting.
So this gets us to the ton-mile insight.
Yes. Total ton miles, which is just the volume of cargo multiplied by the distance it travels, they aren't collapsing. The cargo hasn't vanished.
It's just being redistributed.
Fundamentally redistributed. Instead of these enormous 15,000-mile round trips from Australia to China, we're seeing more frequent, say, 2,000-mile trips, moving coal to India or finished steel to the Gulf.
And that redistribution is the aha moment, because that directly impacts which ships win and which lose. Let's make this concrete. The Capesize reality first.
Okay.
We said they're ruled by the China pulse, which means volatility. Is the Capesize market dead, or has its risk profile just changed?
Its risk profile has skyrocketed. You still need them for the long-haul ore routes, but the volatility is just brutal. A sudden dip in Chinese buying can pull Capesize earnings down by tens of thousands of dollars a day.
And there's no guarantee it bounces back.
Exactly. Owners are playing a very high-risk, high-reward game that's basically tied to Beijing's policy announcements.
But then you look at the mid-size vessels.
And it's a completely different picture. The Panamax, and especially the Supramax and Handysize classes, they are benefiting directly from all of this. The whole Indo-Pacific basin is just getting busier and busier.
Okay, so why are those smaller ships, the Supramaxes in particular, so perfectly suited for this new trade map? What's the technical reason?
It comes down to one crucial detail: gearing. Supramax and Handysize vessels are typically geared.
Meaning they have their own cranes.
They have their own cranes. This makes them perfect for the smaller, less sophisticated ports you find in Bangladesh or Vietnam, or even smaller coastal terminals in India. These places often don't have the infrastructure for a giant Capesize.
And the nature of the cargo is different too.
It is. These are short sea trades. Coastal steel shipments within India, imports of things like fertilizer and clinker, that constant flow of coking coal. The individual cargoes might be smaller, but they happen with incredible frequency.
Which means stable earnings.
Stable earnings, high utilization, and constant opportunities to fix a new cargo.
So it's like we're moving from a single superhighway system, where the Capesize was king, to this complex regional road network where flexibility and frequency are what matter most.
That's a perfect analogy, and you can measure the difference. Our analysis shows that owners with ready-to-go tonnage in the Indo-Pacific region are often outperforming their peers who are sitting empty, sailing toward China, just waiting for that big iron ore cargo that might not even come.
They're capturing the daily income instead of chasing the jackpot. Okay, let's pivot to what this means in practice. Section 4, commercial strategies. Given this shift, what are the new risks, and what should people actually be doing?
The first risk comes from that flood of Chinese steel exports. When China pushes out that much steel, you're suddenly dealing with new buyers, new traders in emerging markets.
Right, not the big state-owned entities.
No, not at all. And they might not have the same credit history, so that introduces a whole new level of counterparty risk that needs to be properly managed.
And I imagine national politics plays a huge role here, too.
A massive role. Charterers and brokers have to be watching policy swings constantly. Specifically things like anti-dumping tariffs. A country gets worried about cheap Chinese steel flooding their market, they slap on a tariff.
And your trade route disappears overnight.
Overnight. A planned voyage to the Gulf can become commercially dead, forcing a really expensive rerouting.
So let's get into the practical advice. For the brokerage community, how should they adjust?
I think brokers need to fundamentally re-rank their client lists. They should be prioritizing companies that value that promptness and flexibility we talked about. Indian steel producers, local coil traders, the regional agriculture and cement players.
So it's not about landing the one big fish anymore.
It's about securing 4 or 5 reliable 60,000-ton fixtures a month instead of chasing one massive 180,000-ton cargo.
Okay, what about for ship owners?
For owners, it's all about risk mitigation. That means preferring shorter-term contracts and regionally flexible trips. Focus on those quick-turn cargoes instead of the long, speculative runs into China. It hedges against that Capesize volatility.
Does having a mixed fleet, some big ships, some smaller help, smooth things out?
That's the gold standard strategy right now, a portfolio approach. Part long-haul Capesize, part Indo-Pacific ready Panamax and Supramax. The stable income from the regional fleet can offset the speculative risk of the Capesize market.
And for the charterers, the people hiring the ships, how should they change how they buy freight?
Charterers need to build optionality into everything. Use regional lotting by smaller parcels from different suppliers instead of one megatender. They also need to build freight buffers into their contracts and, critically, renegotiate things like lay time and demurrage clauses.
Why are those clauses so important now?
Because these newer ports in India and Southeast Asia can have delays, congestion, logistics, things the highly mechanized Chinese system didn't have. When India is the buyer, the cargo sizes might shrink, but the frequency goes way up. Charterers need to use that frequency to their advantage.
This all sounds great in theory, but did we see this play out in the market?
We did. It was illustrated perfectly a few quarters ago. China's ore arrivals dipped, and the Capesize index softened just as you'd expect. But here's the proof of the shift. Simultaneously, Supramax rates around the Indian Ocean tightened dramatically.
Why?
Because all that domestic demand in India, the coastal steel movements, the coal imports, it kept that basin incredibly busy, completely independent of what was happening with Chinese iron ore.
So the owners with the right ships, the geared ones, in the right place, the Indian Ocean, they actually made better money than the guys with huge ships sitting idle waiting for China.
That's the definitive proof. It's structural and it's commercial.
So what does this all mean for you? The bottom line here is that this is a structural rebalancing, not just a temporary wobble. The market's focus is shifting away from pure iron ore imports, which power that volatile Capesize fleet, and toward regional logistics, which directly benefit the high-utilization Panamax and Supramax classes.
Absolutely. The winners over the next few years will be the charterers, owners, and brokers who stop fixating only on the big global index. They'll be the ones who really understand these new centers of gravity and adjust their strategy before the market forces them to. The old model is yielding to the stable, profitable rhythm of regional frequency.
Which brings us to a final thought for you to consider. If the base returns in dry bulk now come from focusing on stable regional frequency instead of just the global commodity giants, what overlooked opportunities are hiding in other local flows? Think about things like fertilizer, cement, or niche grains that aren't even tied to the big swings of the global steel trade. Think regional, think frequency. What flows have you been ignoring?
Great question.
Thank you for joining us for the deep dive. We'll see you next time.